Just gonna go in here. Okay.
Welcome everyone to Name Confidential Live.
Hey guys, welcome to Name Confidential, wrapping up the first options expiration kind of day in 2025. And the market had its typical recent volatility. And so today we got Michael Guide, the Lead Leg Live Report, on to chat with us about some of the stuff that's going on in the markets. And today, what I want to talk about most is really something that's kind of in Michael's wheelhouse, which is the leading indicator of lumber to gold and credit spreads, and kind of what credit spreads and small caps and gold and all this stuff is maybe trying to sort of tell the market, like some of these things that are all of a sudden trading weird a little bit. Like there's a lot of stuff in the market. It just seems weird, right? And so let's work through it a little bit. Where do you want to start?
I mean, hold on. Listen, everything's been weird since COVID, right? It's like it's not really a market. Like I keep going back to all right. People say the market, and then the market it's a bull market. And then I go back, okay, which market? It hasn't really been a bull market for small caps. I mean, yeah, it's gone up, but it's still kind of very lackluster compared to the 2021 highs. Certainly after inflation, it's still in the drawdown. No bull market in bonds, although even that's nuanced. There's bull market in credit. No bull market in duration. It's like, let's define this. So, but it's all weird because usually these things co-move, and nothing's co-moving the way historically it has, right? So, yeah, a lot of frustrating dynamics. I put a post out earlier on at Lead Lag Report showing a chart that looked at rolling bankruptcies against credit spreads and how diverged they are. And I said, look to the left of the equal sign, because I used to always use that line that amateurs look to the right of the equal sign, pros look to the left. So it's like all my concerns about credit risk and a credit event and all the things I've been dead wrong on the last year and a half. And then it's like you look at a chart like that and it's like, we've never seen a period ever where bankruptcies filings are increasing and spreads keep narrowing. So like I get accused of a lot of things, but you can't accuse me of not looking at history, at least to have some foundation for why I form a thesis. But it's been weird.
It's been really weird. And I mean, personally, right, I look at credit spreads and it's like, how much tighter can they possibly get? You know, they're pretty tight by any historical measure. They're nearly as tight as they have ever been. And I don't really know how much tighter they could possibly get, right? At a certain point, if you start, you know, I try to help people understand is like, if you get to a point where you have so much money that you're saying, I'll borrow money to the guy with the 400 credit score,
right,
in the same terms as the guy with 800 credit score, but there's something actually even maybe more concerning and broken in the system at that point.
And I keep going back to small caps because it is not a debate. Small caps have not performed as well because small caps have default risk. Zombie companies that cannot afford higher for longer rates. So small caps are saying there's credit risk because the equities are not participating. They're discounting the possibility that some of these companies go belly up. Credit spreads are saying there's no credit risk. And this has been the whole problem the last basically almost 2 years at this point, right? Really, it's a year and a half. Everyone will say 2 years. It's really been a year and a half when I started going adamant on the sort of credit dislocation point. So, and for all you know, I'll tell you what, for all we know, it could last another year. And the message just gets even more bizarre and everything gets more weird and the divergences get even wider. I'm not a perma bear, but nobody has yet to give me a convincing counter argument around the core thesis that the disconnect between small caps and credit spreads resolves itself in an event, in an extreme.
Yeah. Well, that's like, I keep trying to help, like the way that I describe it to people is in the same way that people say stocks take the stairs up and the elevator down, or, you know, whatever. It's like credit spreads are, it's the opposite, right? They take the stairs down and the elevator up.
Because it correlates to volatility. I mean, you're hitting on exactly the point. There's a direct link between credit spreads and the VIX.
Well, yeah. And okay, so tell me more about that. Like, because one of the things that you posted today is like the term structure in the VIX is you think looking a little funny. So maybe expand upon on that and what you meant by that. And in fair disclosure, I think you have like an interesting enough personality on Twitter. It could have been a whole joke, and I'm just out of the loop.
That is fair. A lot of people don't seem to understand that not everything I say is totally serious. Not everything I say. Some things obviously are. And I was, when I was saying I have a bad feeling about this week, like I had a bad feeling about December, it was right about December, obviously not about this week. But we do have a possible reverse carry trade scenario playing out next week with Japan, right? But no, I was just observing. It's like the market is the market being the S&P. Again, let's define the market, was fairly strong today, as we're chatting on the 17th in January. But if you looked at some of the VIX ETPs, exchange traded products, they actually, the inverse was actually positive. So it's like VIX spot was down, but the futures side. So I was basically alluding to the idea that I hadn't actually looked at the term structure, but because the exchange traded products are basically playing different futures, you can kind of get a sense of things maybe being off, right? So spot VIX down seemed like the rolling front month futures must have been up because the ETPs were, doing something different. Look, I do think you mentioned the options expiration and all this. I do think part of this whole theme of things being weird is that we have all this zero DTE trading. We have all of this covered call type of income generation across multiple funds, which are suppressing volatility because they're selling into that. And I think it just makes analysis more challenging, not impossible, more challenging. Certainly makes the path behavior, I think, much more difficult to try to, get an air pocket right in, right? I think that's sort of the big thing, which again has been what's admittedly thrown me off. Not that I'm bearish. It's just that I'm bullish on a tail event. I keep saying that. I'm not bearish on stocks. I'm bullish on a tail event. You have a dislocation in equities to resolve the small cap credit spread dynamic, and that becomes possibly a real significant start of a real, more traditional bull market.
Yeah. Well, I think at a certain point, any bull market, right, has to go. So, we can debate, are we in a bull market? Have we just been in a weird market that's just, gone up? Whatever it is. I mean, I think we're in a bull market.
We're objectively in a bull market, certainly for large.
Yeah. Not to say, though, that you can't have a period of really heightened volatility that shakes people out of their positions, increases that fear, gets people to want to turn away. That then opens up the opportunity for the bull market to, continue higher because you're on a, more stable footing. Right. When everyone is always, the last person in and they're putting their last dollar possible in the market, like you have to shake those people out so that the market can go higher, right?
Right. Yeah, and you have to cause deleveraging for healthier releveraging. So this is the thing, which is like, the outcome of all of this insanity is what, which you can see it, right? Any kind of a bearish thesis or bearish argument, or it's like the perma bulls will come out viciously and attack your character. It's like, what? Because I'm noting something that you can't give me a counter argument on. And why are they doing that? Because they're making money, and they get, it triggers the part of the brain that makes the dopamine hit, and they feel like they're walking on water because, oh, I was right and this guy was wrong, and oh, ha ha ha, like look at my portfolio versus everybody else's. And then it's like, all right, so what is the effect of that in practice? Overconfidence. Okay, overconfidence results in leverage. Leverage results in crashes. So you need to break the overconfidence. The only way you break the overconfidence is through margin calls to cause a forced deleveraging.
Yeah.
To humble, that segment of the investment community. And then the opposite happens. Then the bears come out, start beating their chest. I was right all along. I was right. Oh, you were wrong. It was an illusion. And then they get overconfident by shorting and leveraging into the short. And so it's like, that's what I'm saying. It's like you can't always be bullish. You can't always be bearish because there's cycles to this. But the one thing you have to be very careful of is you got to check yourself in terms of the overconfidence and the overconfidence of others because of the implication on what it means for actual leverage in the system.
Yeah. Well, the market's got, right, the cruel way of fooling the most amount of people and the most amount of money at any one given time.
Yeah. And it's like, I used to always say, and I should still say it, markets humble us all, just not all at once.
Yes.
Right.
Yes.
So The bulls are having a field day. The large cap tech, the AI, boys and girls and fans, they're going bonkers with how much they've made, and God bless them. I'm not rooting against people losing money. It's like, just because you observe a condition doesn't mean you're rooting for the outcome.
The market's an interesting place because if you look at it through the lens of a trader, it always has to be a net zero game, right? If I trade with you, either it goes up, and I lost because I don't have the asset, or vice versa, or whatever, right? It's a net zero. But when you look at it in the broad context, really, of the market being this more complete ecosystem, we can both be simultaneously right or wrong. And so what I mean by that is, you could be saying, I'm really bearish here, and I could say, well, I'm really bullish. But if my time horizon is 30 years from now on owning large caps, US companies, it's like, that's like, no one's, you're probably not saying, I think the stock market's going to be lower in 30 years than it is today, right? Like that's,
but you're saying, it is, we have bigger things to worry about than the stock market.
Right. But if your timeline is like the next 2 weeks or 3 weeks, or, even 2 years, it's a different story. And so it's one of those things where somebody could sell a stock today and be like, man, I'm a genius because I made money on the way up and I got out, and it goes up another, it doubles in price, and they're happy that they made money and they moved on to something different, and somebody else bought it at that point and wrote it up the rest of the way, and they're happy they made money, and the person that never bought it is happy because they own something completely different, and they might buy it at the top, and it might go down, and they say, well, my time horizon's 30 years, so I'm going to hold it and I'll be just fine eventually. Everyone's happy, right? It just depends what game you're playing. So
there was a guy on X that said to me, you should stop making these short-term weekly predictions. And then I was looking at his profile and his posts on his X account, and he's posting intraday trades. Like, I used to get so legitimately offended and insulted by people that would come at me not knowing that I'm actually going through hell with my own strategies, because they're rules based. I can't do anything. I have to be in long duration treasuries when playing defense, right? For my funds that would run the same way if I died tomorrow. So and which is different from the content. And it's like, these people don't have a clue what they're talking about.
Yeah,
right? And that goes back to the overconfidence.
Yeah,
the people who actually have a respect for market history know that the moment you have overconfidence, it's the end.
Yeah.
That the difference between experience and inexperience is humility. That's the truth, right? Humility, because those who are experienced have gone through enough cycles, have gone through enough whipsaws, have gone through enough drawdowns to know that even though they might be making new highs on their equity curve, be careful.
Yeah. Well, I mean, so speaking of a bunch of overconfidence, let's transition to, lumber and gold, because gold has been interesting. It's been going up the last couple of weeks with the dollar, right? And that's not normal. I'll say that is
back to our theme of weird. Everything's weird.
It's atypical, but it has been, right? And and then you take it back to real estate, and there's always I find there's never any shortage of confidence in real estate, especially with leverage. And you've got a paper you've written about using lumber as a proxy for housing starts and its strength relative to gold, as sort of I want to say the word predictive. Why am I not thinking of it? It's a leading indicator of kind of recession, right?
Well, and of two things in particular, and this is where I think people that I haven't read the research, they get confused by it, because I think it's about the signal being wrong the last several years. The signal's actually not been wrong at all, or rarely wrong. It's been the expression through treasuries. It's the opportunity set, not the signal.
Yeah.
But the two things that it's a leading indicator of historically are, one, volatility. So lumber outperforms gold. Typically, volatility is lower for stocks. It doesn't mean stocks go down. It just means volatility is likely to be lower. Or if stocks go up, it just means volatility is likely to be lower. Volatility that's likely to be lower is beneficial for, it's what you see in uptrends in general. But the characteristics around volatility. But the other major thing, which is where lumber to gold has been spot on, especially last year, is when gold is outperforming lumber, large caps outperform small caps historically. So it's more than just volatility. There's also a market cap tell in terms of where to tilt. So last year, gold was outperforming lumber pretty much the whole year. Typically, that's a risk-off signal. Instead, it just ended up being a large cap signal, which was the right call because small caps still largely sucked.
Yeah. I mean, relative, right?
Relative,
I mean, I think
right.
What it was still better return than, owning bonds or something, or
Yeah, of course. Right.
Right. Still, still got an equity return. I'm not a small cap guy myself, so I'm not going to sit here and defend them too much, but so what is there any correlation then, like, or interpretation on the kind of reading in the correlation between lumber and gold when gold starts trading in line with the dollar?
It's an interesting question. So I do believe, and this is part of my own frustration also, because like had I with my funds, my mutual fund, my 2 ETFs, had instead of using treasuries with the exact same timing of the signal, I used gold. Exact same timing of the signals for each respective fund. Very different returns.
Mm-hmm.
Right? It's again, I go back to the problem is not the signal, it's the expression of the opportunity set playing defense. Treasuries being awful this time around. Now, I do think gold has been a beneficiary of scared capital that otherwise would have gone into long duration treasuries. Mm-hmm. That has been saying, you know what, with all this government debt and all these concerns around, the way the treasury is playing with the yield curve, I'd rather own gold than own long duration treasuries as my scared sponge to take my capital, right? And as you noted, gold has outperformed pretty much everything in whatever currency you're looking at, right?
Yeah.
I don't know if there's anything you can necessarily attribute that to. I don't know if that alone is a signal of anything. It's probably, if anything, just more of a reminder that the asset which people wrote off is often the asset that ends up having the best risk-adjusted returns on a go-forward basis after it's written off. Gold had done nothing for a decade up until basically October or August of 2023, when I myself started getting very bullish on it. For all the arguments of me being a bear, it's like I was wildly bullish on gold. I still am bullish on gold. I think gold has way more upside potential than people realize. Same thing with utilities. Same thing with the dollar. Same thing with treasuries, which again, I've been wrong on that, right?
Yeah.
But it's new. But yeah, I don't know if it actually tells you anything, but I do think it is a testament to the fact that there are not that many options to play defense in terms of being a large enough bucket to take big sums of capital when treasuries are not the option that you can choose right now.
Yeah. Well, what's interesting is if you went into 2024, thinking you're pretty bearish, and your expression, and I think you've called this out too, if your expression was buy gold, you actually were really
crushed it. Yeah, the bears were right in that sense. If you, that's really right. Like that's why I also say don't short. Like if you're gonna be bearish, be bearish by being long things that would still benefit from high volatility regimes, but in the event you don't have the high volatility regime, maybe they still work, which is exactly what happened with gold. And you've never seen, by the way, in history, a time where the S&P and gold were both up 20% for the year. Right. 20% plus, whatever the number was, right, for both.
And I didn't realize that.
Yeah, never seen it before.
Maybe you don't constantly be long the VIX though. That might be a bad idea.
Well, with the rollover, you got to be real careful with that.
Yeah.
But the VIX, you can argue is, when the reverse carry trade happened, the VIX hit 65, right? And everyone freaked out, and some will say that was an erroneous, trend.
What's interesting though is like that was only spot VIX, and you can't really buy spot.
Yeah, VIX. Exactly right.
And so it went up, but there's like if you were long vol, you still didn't get the spiked return that you would have otherwise been hoping for, right? I mean, I'm sure there's someone out there that's figured it out, and they, that's like what they do, and maybe they nailed it. Maybe, I don't know.
Right, maybe.
But in mass, I think the people that thought they were long vol going into that, for whatever reason, they felt they had the foresight and they were long vol. They still didn't get the return that somebody would calculate, saying, well, they went to 65. That's what they cleaned up on.
Yep, I think that's exactly right.
Probably not the case at all. One of the things that, so I did pull up like the VIX term structure, just because we had been talking about it, and it is in contango. There's no weird backwardation. And I think it looks like relatively normal. But one of the things that I interestingly check is, VVIX divided by
the vol. Yeah.
Yeah, the vol, and that did spike today quite a bit.
And somebody showed me, you could be wrong, somebody showed me a chart of, I just looked at it briefly, I can't verify it, but looking at the put call ratio, like just collapsed.
Really?
Yeah, so again, who knows if it's something or not, but it's worth paying attention to things that are extremes. For me,
Even the put call ratio was up like 62% today.
Okay, I'll see if I can pull that chart. It was something, I think it may have been like a rolling something that I saw. It was like very like extreme.
I mean, it looks like, yeah, I mean, yeah.
Yeah, I see it. Actually, I tried to repost it. So yeah, so into the long here it is. It's was what somebody. I will send it to you, and you can maybe put it up later. But yeah, it's on my feed. It's from one of the accounts that follows. Like put to call ratio going into long weekend, and it was like it's like up and then collapse, right? So maybe that's just the options expiration. Who knows, right? That's
I don't know. I don't see the collapse side of it. I just see the put side going up. But I mean, it's What one of the things I didn't look at before I had a chance to get on here. Let me pull it up really quick. Is the NAIM exposure index, which
that's not quite a plug name, by the way. I will say that's that's a pro move right there.
Well, the looking at it here, let's see, exposure index. The reason I bring it up is because it had like collapsed.
Yeah,
I mean not collapsed. Collapse is a little hyperbolic, maybe. It had really dropped like quite significantly. Last week it was down at it was down at 64, and last quarter's average was 85. And it looks like it picked back up this week to 70. But in mass, it's still on, not the lowest it's certainly ever been. For August 14th last year was down at 56.
Yep.
It kind of hit a 56. Like 56.60 is kind of seems to be the average of the normal bottoms, right? Without introducing major market events.
Yep.
And yeah, I mean 60, 64 on January 1st. That is pretty low. Some people say though it's because active managers just get it wrong, and it's this contrarian signal. I think it's not.
So I
don't understand how the index works, but that's the reputation it gets.
I have issues with all this. So the fundamental problem I have with all this stuff is that people will reference the sentiment data, but they won't actually think through what's the time frame of the question that's being asked to the poll participants. So it's like, all right, well, are you bullish or bearish? And then you ask, it's like, oh, well, everyone's bearish on the poll, which means we're going to run. Well, but is it bullish? Is the question framed as bullish or bearish in the next year? Like, what's the time frame?
Yeah.
Like you can't, unless you factor in the time frame, how can you say it's a contrarian indicator for the very short term? And the one that drives me the most bonkers is you see it all the time. People show the CNN fear and greed. Oh my God. Look at what goes into it's no sentiment. Look at the actual components of what goes into the index. There is literally nothing about that index that tells you a damn thing about fear and greed, but they show it as
what does go into it? Enlighten us.
Yeah, it is. I mean, I'll pull it up as we're chatting. So it's all like different metrics. Credit spreads is one of them, right? I mean, it's quantitative metrics, but it's not like it's a poll. It tells you nothing about positioning. It's it's like, okay, so what I think one of them is like, how far away you are from the moving average of the last 10, 20 days. Well, why is that a sentiment indicator versus 30 days, 40 days, 50 days? Again, if people would actually just stop and look.
I guess what I'm hearing you saying is it's a quantitative, essentially a quantitative indicator
where the components are not. It's not clear why the look back periods are chosen the way they're chosen, why they're indicators.
I guess even if they had their own proprietary reasons and their own data and research of why we selected a 20-day period instead of a 25 or a 15 or whatever,
right.
It's still it still doesn't indicate anything about sentiment.
Right. Like here's it going. Okay. The 5-day average of the put call ratio. Well, why 5 days? Why does that tell you anything about fear and greed?
Yeah.
But okay, market volatility, VIX and its 50-day moving average. Why does that tell you anything about fear and greed? I mean, you're applying a smoothing mechanism around something which is very volatile, like extremely volatile, where there's going to be more noise, not signal.
Yeah, I think you don't want to. Isn't am I the only one that thinks it's crazy to try to smooth something that's extremely volatile? Like, why would I want to over smooth
Yeah, because it will be right, correct, because it looks like a trend when in reality it does. It's
Like the VIX, but the
noise.
VIX can't trend. It's like the VIX.
Right. So it's like that's the kind of stuff. And I go back to this is what's happened because of all of this liquidity that the Treasury has put in to counter the Fed's hiking cycle. It has resulted in a lot of people have made a lot of money. Don't get me wrong. God bless them, and I hope they keep making money. You know, you never want to root for anybody to lose money. Okay, we have one life on this earth, and everybody has a right to get lucky. A right to get lucky. Okay, I mean, capitalism gives you the right to get lucky. Communism, socialism does not give you the right to get lucky, right? So, but at the same time, it's like if people are not even thinking, it's like it's not investing. It's just let's reference data points that have no predictive power at all and use that as our confirmation for why we're right and everyone else is wrong. And on top of that, let's insult others while we do that. It's like this is the kind of stuff you see towards tops, period.
Yeah. Well, whether it's a short, mid, or a long-term top, there certainly is not a shortage of volatility in the market. And I think there's not really a consensus amongst a lot of people. I mean, when I've even seen almost Ryan Dietrich pull off a little bit, where he was, for like the longest time, he was like a bull and no one was, or he was kind of like the loudest of the people that maybe were bullish. And I think he is still bullish, but it's like, I think he's, even he's starting to see like maybe there could be a good size correction here at some point, right?
Yeah.
Before, and I think he's somebody that thinks the market's going to go higher. I don't know Ryan personally. I think he puts out good stuff, but it's right. But I think that's generally true, right? Like what I know is that the market has a decent chance in the future of being lower than it is today, but likely will also be higher at some point
Yes, of
today
course.
as well, right?
Right.
It's just the way it works.
Which is why you can't be a perma bear. It's like I've been doing content and writings and analysis. I was one of MarketWatch.com's top writers for 15 years. You think I'd still be here if I was a perma bear?
Yeah.
I'd be serving McDonald's hamburger patties. Like,
I'd be calling you Jim Rickards.
yeah. Well, but Jim Rickards is definitely wealthier than I am. Because he's got a book and I that by far a bestseller. Anyway, look, I bottom line is what I think. I keep going back to nothing has really changed in terms of the divergences.
Yes,
a lot of the optimism. Now, look, I do believe that deregulation is going to be very beneficial longer term. I do believe that it should benefit mid caps and small caps because they're the ones that bear more of the margin hit from regulatory frameworks. So I do think that we could be entering this really powerful era where small caps and mid caps actually do work. But you have to, I would argue, have a sizable correction to bring yields down, to finally bring back the flight to safety, the Phoenix, which I just doesn't want to come to help me out for my own strategies. But that would bring yields lower. It would take care of the refinancing risk for a lot of these small cap companies. And then, yeah, they probably do run.
Yeah. Yeah. I mean, my own personal opinion is I think different than yours on the natural or kind of structural trajectory of interest rates in the coming years on the long end of the curve. But I certainly, wish you well in your strategies nonetheless.
Yeah, I wish well too for a nasty cycle here. And I know that as we're coming up on time with the half hour mark, I'll say that look, everything has a cycle.
Yeah.
Right. And so I always say there's no gurus, only cycles. Like that's I'm glad that people have caught onto that quote and referenced me because I do believe that. How many times have we seen a star fund that's because of the star manager? It has nothing to do with the star manager. It has everything to do with just the right place, right time, right?
Yeah.
Which goes back to humility. The difference between experience and inexperience is humility, right? So this cycle of passive large cap only dominance is going to end. I happen to believe sooner than later, but I also believe that last year. So I don't know what tomorrow brings. All I know is that I hope that the conditions continue to evolve, because if it's just going to be a game of just the S&P and nothing else, that's going to end really badly, because at some point then we're no longer a capitalist system where the Federal Reserve bails out 7 companies as opposed to the economy.
Well, wrapping it up, like we got 1 minute left. I think like Mike Green, I don't know if you know Mike Green.
Yeah, no, Mike.
I think he's done some really interesting work on this where, he points out like he, somewhat facetiously says like, dance with the music's playing on this whole thing. It'll continue until it doesn't. And until it continues, if you're kind of not on that trend, you're going to most likely look wrong
Yeah,
until it ends.
yeah.
And, and the longer it takes to get there, the worse it's probably going to look, when it does.
Yep.
So, play your game however you think is best and most appropriate for you as an advisor, an investor, or whoever you are.
Yep.
And good luck to everyone out there. So I really appreciate you hopping on, Michael. It really means a lot to us here at NAIM. We appreciate anyone that's tuned in to listen. We do these typically 30 minutes after they close on Friday. Every Friday, we have a couple different hosts at NAIM here that host them. And if anyone out there is interested in hopping on, send me a message, find me on Twitter, send me a message. We can, talk, maybe get you in the rotation. And, if anyone listening isn't following, Mike, your Twitter handle is at lead lag. Is it at lead lag report or is
At lead lag report? Yep.
Yeah, at lead lag report. Great follow on Twitter. I really enjoy a lot of the content you put out. And I think your newsletter is great too. So appreciate what you do for the active investment community. And thanks for spending a little bit of time with us here today.
Yeah, no, my pleasure. I appreciate it.